The stock market opens at 9:30. Everyone knows that. But 90% of traders lose money in the first 15 minutes. Here are the 7-time windows where real wealth actually gets built. Let me tell you something the financial industry doesn't advertise. The stock market isn't just open from 9:30 to 4. There are actually 6 distinct trading sessions every single day, and most retail investors only participate in one of them. The regular trading hours everyone focuses on? That's where you're competing directly against algorithms that execute trades in microseconds. But here's where it gets interesting. The real price discovery, the moments where institutional money reveals its hand, those happen outside the hours you're probably watching. And this isn't about day trading or timing the market in some get-rich scheme. This is about understanding when your buy and sell orders actually get the best execution. Because placing an order at the wrong time can cost you 1 to 3% on every single trade. Over a lifetime of investing, that's hundreds of thousands of dollars in lost returns. Let's start with what most people think they know. Regular trading hours run from 9:30 a.m. to 4 p.m. Eastern Time, Monday through Friday. The New York Stock Exchange and NASDAQ both follow this schedule. Markets close for 9 federal holidays throughout the year and sometimes close early at 1 p.m. the day before major holidays like Thanksgiving and Christmas. Simple enough, right? But here's what they don't teach you in basic investing courses. The opening bell at 9:30 doesn't mean trading starts at 9:30. By the time that bell rings, billions of dollars have already changed hands. Pre-market trading begins as early as 4 a.m. Eastern on most major brokerages. And after-hours trading extends until 8 p.m. That means the real trading day is 16 hours long, not 6.5. If this is already changing how you see the market, drop a like so I know to keep diving deeper. Most retail investors are playing a 6-hour game in a 16-hour arena. Now let me shift your perspective entirely. Pause 2's, the first critical window is pre-market trading, running from 4 a.m. to 9:30 a.m. Eastern. But here's what nobody tells you. The 4 to 7 a.m. window is essentially dead. Volume is so thin that spreads can be massive and prices don't reflect reality. The real action starts at 7 a.m. when major brokerages open their pre-market sessions to retail traders. Between 7 and 9:30, you'll see the market digest overnight news, earnings releases from before the bell, and economic data drops at 8:30. This is when institutional traders position themselves for the day. They're not waiting for the opening bell. They're already making moves while most retail investors are still drinking coffee. And watching this pre-market action? It's like reading tomorrow's newspaper today. The direction established in pre-market often, not always but often, predicts the first hour of regular trading. Think about that for a second. You can see where the money is flowing before the game officially starts. The second critical window is the opening auction and first 15 minutes. From 9:28 to 9:45, chaos reigns. The opening auction between 9:28 and 9:30 is when the exchange calculates opening prices based on all the orders that piled up overnight and during pre-market. This 2-minute window sets the tone for everything. But here's the trap. Retail traders love to place market orders right at the open. They think they're getting in early. What they're actually doing is buying at the worst possible prices of the day. Volatility in the first 15 minutes averages 2 to 3 times higher than the rest of the session. Spreads are wider. Algorithms are hunting for stop losses. Emotional traders are panic buying or selling based on overnight news. Unless you have a specific strategy that exploits this chaos, and most people don't, the smartest move is often to watch the first 15 minutes without participating. Let the volatility settle. Let price discovery happen. Then make your move with better information. The professionals call this letting the dust settle. But here's where it gets really interesting. Pause 2's, and this is what separates people who understand markets from everyone else. The third critical window is the mid-morning sweet spot between 10 and 11:30 a.m. Eastern. After the opening chaos settles, something fascinating happens. Volume remains strong but volatility drops significantly. Institutional investors who waited out the opening madness start executing their real orders. The spreads tighten to their best levels of the day. And here's the data nobody talks about. Historical analysis shows the trades executed between 10 and 11 a.m. statistically get better fills than any other time during regular hours. Not by much, maybe a few cents per share, but across thousands of trades over years of investing, that adds up to real money. This is when the market is operating most efficiently. The noise has cleared. The signal is strongest. If you're going to place orders during regular market hours, this window deserves your attention. But that's not even the most important time of day. Stay with me, because what comes next changes the entire game. The fourth window is the lunch hour trap from 11:30 to 1 p.m. Eastern. And I need you to pay attention to this part. Pause 1.5s, volume drops by 40 to 50% during this window. Traders on Wall Street literally leave their desks for lunch. And what happens when volume drops? Volatility spikes relative to the trading activity. A relatively small order can move prices more than it should. Spreads widen slightly. And liquidity providers step back. The lunch hour trap catches retail traders who think they're being clever by trading when it's quiet. They're actually trading when the market is least efficient. Unless you're specifically trading a lunch hour